just because you love the product, that doesn't mean you should love the stock. Look, I love Levi Strauss. The Levi's, the pants, not so much Levi's, the stock. Wearing Levi's jeans on the weekend, great idea. Wearing Levi's, the stock on a trading day, let's just say you're dressed for lack of success. With the darn thing plummeting 12% today on hideous guidance after a just okay quarter. Like I mentioned earlier, Levi's came public on March 21st, and it was done with much fanfare. It was the first big deal of the year right before the Lyft debacle, and it primed the pump for the big IPO cycle. Now, Levi's, the company, has a storied history. It's been kicking around since 1853. It has terrific management. We've had it on the show. Chip Bergh, CEO, seasoned executive. So it made sense why the stock immediately went to a premium. After pricing at $17, it spiked up to $22.22 at the open and then closed at $23.66. Big success. At those levels, though, Levi's was trading at 22 times earnings, which was more expensive than the average apparel stock. Not totally unhinged, but this was a rookie stock, even though the company had been around for more than 100 years. And the first quarter out of the gate, okay, maybe that justified the valuation. Levi's did a really good job. But the quarter they reported last night, the market has decided it was a bomb. Now, maybe it wasn't a thermonuclear device, but I would say it was a napalm-loaded canister scalding the shareholder base. All right, is the market right? If you only looked at the headline numbers, today's sell-off might seem like an overreaction. Levi's delivered better than expected sales and earnings, and the forecast was technically better than expected. Technically, even though they did talk about a meaningful sales slowdown in the second half of the call. But if you want to know why everyone dumped the stock, sell. It's because of the customers of Levi's, especially the customers in the United States. It looks like America is overrun with denim right now. Department stores just have way too much of the stuff. While Levi's U.S. sales were up 1%, the company had a 2% decline in the U.S. wholesale business, perhaps their most important channel. As Harmit Singh, the very thoughtful CFO, explained on a conference call, and I quote, the U.S. wholesale decline was attributable to the impact of the bankruptcies and door closures that some of our customers have experienced over the last year, as well as a decline in discounted sales to the off-price channel, end quote. In other words, some of their customers are either going out of business or rapidly shrinking their store count, and that is not great. Worse, Levi says they expect growth in the second half to moderate relative to the first half, particularly in the U.S. Ouch! Worst of all, though, let me read you this next dispiriting snippet from the call. Remember, I always tell you to listen to the call before you do any investing. Quote, we anticipate that pressure in the wholesale channel will adversely impact us by roughly 200 basis points in the second half due to the bankruptcies and door closures since a year ago, the overall softening U.S. wholesale environment and the lower off-price channel sales, end quote, and awful. All of this for a company that supposedly had better than expected earnings and guidance? Maybe Levi's can be saved by its overseas business, you think, like China? Not so fast. China's about 3% of their business. That's not going to save anything. It's not like this is a great time to be an American company, the People's Republic, anyway. Don't get me wrong. It's not their fault that American department stores are getting clobbered here. And even when Levi's came public a few months ago, it was hard to tell how tough their customers would have had it. Not a lot of people saw this, but frankly, the stock's horrific sell-off, I think it's more to do with shareholders than the company itself. Levi's makes excellent products, right? I mean, don't we love this look? Well, I mean, some of us love it, but the shares should never have been so expensive in the first place. What the heck was this thing trading at 22 times earnings with a weakened customer base and a retail environment that's swimming with sharks? That said, Levi's did itself no favors here. They could have telegraphed maybe some of this weakness beforehand. They could have given us a better sense of how they might fight back in this environment. Let me put it this way. When you're hosting a quarterly conference call and you need to say something like, so we do have a strategy, end quote, that's not reassuring. Ultimately, the fault is in both their stars and, I think, themselves. It's a Shakespearean tragedy, not a history, so not a comedy, not when a stock is down more than 12% in a day. Bottom line, Levi's the stock, not the jeans. Should be much lower, maybe back even to where it came public. Hence today's monster decline. But the big takeaway is that Levi's is foreshadowing what's going to happen to the entire apparel industry in a world where Amazon, Walmart, Target, and Costco are thriving at the expense of everyone else. These companies, they've got pricing power, they have clout, and they are using it against the suppliers. That's bad for Levi's, but it's also bad for everyone else who sells into retail, too. Stick with, got to return these jeans, Cramer.
Don't miss a second of Mad Money. Follow @JimCramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or Give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.